The United Kingdom is currently experiencing a property boom while simultaneously going through a deep recession. So, how is this possible? Join us today at the Data Cog to learn more. Since we learn our most valuable lessons from history, we must look at the last property boom in the UK and compare the characteristics with the current one. So let's rewind back to 2005. So the year is 2005 when James Blunt was top of the charts and George W. Bush was sworn in for his second term as President of the US. Prince Charles married Camilla Parker Bowles, and London had just won the rights to host the Olympics in 2012. Aside from all the political and cultural events, the house prices were at an all-time high in several locations within the UK. The market sentiment is quite well captured in this BBC article from 2005. The Bank of England base rates had risen 4 times in the previous year, and there were ongoing concerns around the price increases and the impact it will have on people looking to get onto the property ladder. However, there was no sign of stopping, as shown by this average UK house price graph, which was just increasing. And as ever before a bust, the general population truly believed this would last forever. This trend continued into 2006 and 7, and to keep up with the ever-increasing demand, the banks did some fairly shady deals, selling mortgages to individuals that couldn't afford them, or interest-only mortgages for people that couldn't be sold a traditional repayment mortgage. All in all, if you wanted to get onto the property ladder and could afford a 5% deposit, as long as you could find a house, you would manage it on the ladder by hook or by crook. Soon enough, all of this would be unraveled as artificial price increases became more and more unsustainable. People started defaulting on their mortgages and the UK housing market bubble finally burst.
Britain's economy shrank at its fastest pace in nearly 3 decades at the end of last year, sending the economy into recession for the first time since 1991.
And the government got involved.
We are fighting this global recession with every weapon at our disposal.
And the banks were bailed out.
It began with the bailout, the Prime Minister and the Chancellor making it clear that the financial system is so important to our society that by saving our banks, we're saving ourselves.
So what characteristics did the property bubble have in 2008, and are those being exhibited in the current climate? Unlike 2008, the current recession is much worse in terms of numbers.
The British economy has suffered its worst slump on record.
When I was here a few months ago, I said that hard times were coming, and today's numbers show that hard times are here.
So which numbers is the Chancellor talking about? In the 2008 crisis, the GDP slumped by 2.1%. In comparison, the 2020 recession, the GDP has slumped by 20.4%. I did say it was worse. However, there is a distinct difference that it is not due to the property markets or the bankers, but rather due to the coronavirus, which forced governments to shut down majority of the economy. Since the lockdown, much like all other industries, the property market was also closed, which created pent-up demand, in addition to people now having different requirements for their housing needs, including extra outside space and work-from-home facilities. The house price index graph, taken from Nationwide, has translated this pent-up demand into increase in the property prices. To put this into context, let's look at the house price index for the last 6 months of 2019. I'm sure we can agree that this graph is fairly similar to the one that was seen back in 2007. As there were artificial factors in the 2008 crisis, including the bankers lending more money than could be afforded, this time round the government has provided a number of economic measures to keep the market afloat. Measures such as 300 billion plus in loan guarantees, business rate scrapping, debt payment holidays for individuals that are unable to afford their mortgages. Furlough scheme at its peak had over 9 million people taking advantage of it, in addition to the coronavirus business interruption loan and no repossessions, and to top the cherry on the cake, the removal of the stamp duty until March 2021. This, in my opinion, has provided a boost which will be unsustainable. As more of these schemes come to a halt and more of the government loans have to be paid back, we will truly understand the extent of the damage to the economy and to the real estate market. There will likely be a house price falling in 2021. All this has yet again created a false sense of security and demand in the market, which had led to headlines such as this, and this, and this, and this. Finally, will the impact on the market last as long as the previous recession? This is a tricky one, as the previous recession had all the hallmarks for a crash. This one almost doesn't. What I mean by that is the interest rates are lowest they have been for more than 300 years. Affordability for mid to high income families has actually been boosted with the lockdown, as less people spent money on commuting, on summer holidays, etc., and many kept their jobs working remotely. But as mentioned before, the unemployment rate, due to various government schemes coming to a halt, and lenders being extra cautious with their high loan-to-value products, and the serious likelihood of a second wave of the virus over the winter, this could go either way. The Bank of England had initially predicted a V-shaped recovery. However, they are now saying this is unlikely. Remember, the previous recession took nearly 6 years to recover. We hope this video has been insightful. If you have any questions or comments, make sure you add them in the comment section below. And do like, share and subscribe to this channel. We'll see you in the next one.